Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your day to spend some time with us. As we always try to present on our show, a lot of information, an information-packed show, as I like to say. On our show today, we're actually going to talk about some things that are coming up in the near term, some targets for the future, and we're going to touch on a very big and crucial deadline that has just come and gone. Late last night, we heard from President Trump talking about this most recent deadline for tariffs, and we're going to touch on that right off the top of the show. So let's put up what we are going to have on our show this afternoon. Intense U.S.-Canada trade negotiations leading up to today's tariff deadline. As I said, the deadline was midnight for an extra 50% tariffs on a bunch of goods that we ship down to the U.S. That has come and gone. There's been, I guess, a pause for 3 more days while the details of a deal are finalized. It sounds like Canada and the U.S. has some sort of deal on the table, and perhaps it will involve Keystone Pipeline, something that we haven't really spoken about in quite some time. We'll have to, I guess, see or receive the details shortly. Top 3 things to consider over the next 5 to 10 business days. 3 things that I think individual investors need to be focusing on before you make your investment decisions. S&P 500 targets lifted for year end. A lot of institutions down in the US lifting their end of year targets for the S&P 500 as investors grapple with bigger market swings. We were noticing some big swings in the market day to day, week to week. The net result doesn't show up an awful lot, so it may go up maybe a few percent, then down a few percent, but net, the moves are actually fractional. Market buying opportunities are harder to find. I always tell people there are always opportunities to buy investments or bonds or just investment ideas in general, and it is always the job of the investment advisor to find those good ideas for you on a regular basis. Yes, sometimes they're more difficult than others, but there are always good ideas out there. New Fed Chair Kevin Warsh to speak at Jackson Hole. This is the famous speech that the head of the Federal Reserve gives every year, this time of year at the end of August, last week of August roughly. And I think it's going to be market moving because we don't tend to hear a lot out of the new Fed chair. Kevin Warsh tends to be a little bit more quiet, or a lot more quiet than previous Federal Reserve Jerome Powell. And what he said could be market moving. Quick hits, 3 things in the news that I've seen recently that I wanted to comment on. And last, but definitely, as always, not least, your questions. If you have any questions regarding anything that you've heard me say in today's show, please put them in the chat boxes. Someone will come around, pick up those questions. I'd love to answer them on this show. But if I don't get a chance to do that, we will answer them on the next show. So without further ado, let's move on to our first segment, talking about Canada-US trade. So Canada-US trade negotiations really has been in the news and kind of on the back burner at times, on the front headlines at times, or the front of the newspapers, or the front of all the different social media for quite some time. And recently, I guess, to kind of maybe push the envelope a little bit, President Trump announced 50% tariffs on a bunch of goods going to the United States, an extra 50% on top of on top of many of the other things that already have tariffs on them. And the deadline was August 19th, today. And by midnight, I guess last night or early this morning, that was the deadline for these 50% tariffs to kick in. And lo and behold, just before midnight last night, we received, or the world received, or Canadians most importantly, received a tweet from the president. Let's put that tweet up that came out on X. There it is, real Donald Trump. I have paused the 50% tariffs against Canada that were scheduled to kick in tomorrow morning for a 3-day period based on the fact that Canada and the USA, subject to finalization of documents, have a deal. The Great Keystone XL pipeline, long ago killed by sleepy Joe Biden, may be awoken from the grave. Thank you for your attention to this matter, President Donald J. Trump. So here we are. We were hoping for some sort of trade negotiation. We know that the Prime Minister was on the phone with President Trump in the last 48 hours or so. Probably the best thing to do. Maybe they should have had this conversation between the two leaders, days ago, weeks ago. Maybe we would have avoided a lot of these things. But here we are. 50% tariff has been avoided, at least temporarily. And we move forward. Have negotiations stopped or are they done? Absolutely not. I'm sure that the phones are being worked on both sides because I don't believe anyone wants these tariffs to come into play. The 50%, I know that both sides of the border, especially the border states in the United States and really all provinces here in Canada, they want to see a significant reduction in the tariffs between Canada and the US. We're hearing it more and more from different bodies, different areas in the US, different states, Chamber of Commerce. We have a quote coming up shortly. So everybody really wants to see these tariffs either get significantly reduced, or go away altogether. Will that happen? I'm not sure. We're going to have to see the details. What will we have to, I guess, agree to, give up perhaps, to make a deal with the United States? We have a lot of things in place that protect many sectors in our economy. What will we have to, I guess, protect a little less, maybe? Dairy, telecom, banking, lumber. Not sure what we have to do, but I guess we're going to hear in the coming days. Our first chart that we have, an interesting one, shows the possible jobs lost or gained in 2027, depending on the outcome of the trade talks. And you can see there, a renegotiated CUSMA could add maybe as many as 98,000 jobs in Canada, maybe 137,000 jobs. Obviously, these are estimates. If we were to come to some strong deal, and look at the other way, if an outcome goes sour and there is no deal done, could mean job loss on both sides. 214,000 jobs they're estimating could be lost in the US. I would imagine, again, it's mostly or mainly border states, but make no mistake, a lot of states that don't border Canada still do a lot of business with Canada, especially, I know that the alcohol, us banning alcohol from our shelves of US alcohol, really has hurt some of the big businesses out of the US, which are, not just border states, but further south in the United States. Our next it's a quote, and this is, as I mentioned, the U.S. Chamber of Commerce calls for Canada and the U.S. to cut a deal to avoid more tariffs. This is a quote. Our next one, we can pull it up here. The introduction of higher tariffs would damage both economies, drive up costs for U.S. families, further disrupt critical supply chains, and risk the 13 million American jobs that depend on trade with Canada and Mexico. So this is the U.S. Chamber of Commerce saying, we need to get a deal done here. We need CUSMA or USMCA, whatever you want to call it, whatever they call it down in Mexico. I'm sure they'll put M first on the acronym because it would be M for Mexico first. But we need to get a deal done. I think it is very, very important. And frankly, I'm surprised it's lingered on this much. I know that no deal has been worked on as yet or agreed to for CUSMA. And it seems as though right now, anyways, uncertainty still exists and that negotiations would have to happen on a regular basis every year. Some of the major threatened sectors we could show our next chart. There it is. Value of 2025 Canadian exports to the U.S. under tariff threat by category. And these are the recent tariffs that would have come into effect. You can see electronics and electrical equipment, number one, plastics, furniture, industrial machinery, paper and paperboard items. You can see these are billions of dollars of I guess, goods that would be affected if the 50% tariffs were to have come into play, which for now have not. Our next chart shows what we call the Sector 338 tariffs and their economic impact by targeted industry. Sector 338 tariffs are the ones that were going to come into play as of midnight last night or this morning that have been postponed for right now 3 days. Apparel and leather products, electrical equipment, as we said, textiles, computer electronics products, beverages, tobacco products, paper, wood products. And you can see here the share of jobs that are impacted is in the yellow, and the share of GDP impacted is in the blue. So quite a bit would have been impacted. many people just don't understand what President Trump was thinking. And of course, we all know what his tactics tend to be. And many thought that this was just a tactic to get Canada to the bargaining table more urgently and to consider giving up, something in return for the United States lowering, or in this case, getting rid of some of our tariffs. Next chart that we have is an interesting one showing the map of Canada. And interesting, I find, is that Ontario actually is not the province most affected by U.S. Tariff threats. You look at BC in the far west, they are the proportion of exports to the U.S. under tariff threat based on 2025 trade values. You can see that there. BC and Quebec close to 12%, whereas Ontario is probably closer to that 10% mark, followed by, looks like Manitoba, and then you'll look at the western provinces, Alberta, the least affected, maybe just 2%, along with Saskatchewan, because keep in mind, the United States gets a lot of energy, a lot of oil from Canada, and so I believe that is why those two provinces are affected a lot less. So yes, the deadline has come and gone for this set of tariffs, but make no mistake about it, we're only given a 3-day reprieve. Hopefully, the final details of what Canada has agreed to and the U.S. has agreed to will come out shortly, and they can put, I guess, pen to paper, sign a deal, and get rid of not only the 50% tariffs that we're going to go on, but also reduce some of the other major tariffs that have continued to hamper Canada and many in the United States as well. The relationship between two countries, in my opinion, hasn't been as poor as it is right now in quite some time, maybe ever. President Trump has a way of doing things, and unfortunately, that's not always a positive thing for many countries around the world, including Canada, which shares a border, the longest border, the largest border between two countries anywhere in the world is between the United States and Canada. So we need to work together. And hopefully we can not only sign this deal, but sign perhaps even a bigger deal that would encompass all of CUSMA and renew CUSMA so that we can move forward, Canada, US, and Mexico, and build, as Premier Ford says, Fortress North America. Fortress North America to take on the rest of the world. So we'll have to see how it goes. But over the next 3 days, I think we're going to hear a lot of information coming at us, and we'll have to parse through it all. Now we come to the very popular part of our show, top 3 things to consider over the next couple of weeks before you make your investment decisions. We always have 3 things, very popular segment of our show. U.S. Treasury bond yields and interest rates moving higher. That's not one we see here quite often, talking about yields and bonds. Most of the time, we're talking about stocks on our show, but the bond market, understand, is much larger than the stock market, and many believe, of course, much more important than the stock market as well. And when we see bond yields moving up around the world as much as we have, and of course, the United States being the largest economy, seeing yields moving higher in the US, that spooks investors. And we're going to talk about that, why it's so important. Upcoming quarterly announcements. Biggest company in the world, NVIDIA, or one of the biggest now. They tend to flip-flop back and forth. NVIDIA is the largest, followed by Apple, and sometimes it's Microsoft. But I think NVIDIA now has the crown once again as the largest company in the world, largest tech company, and at the center of artificial intelligence. We're also going to get Canadian bank earnings, very important for all of us here living in Canada. Canadian banks and financials make up the largest component of our stock market. We're going to get earnings from NVIDIA and Canadian banks next week. Our third point is obviously one that we see quite often here, the latest out of the Middle East. The memorandum of understanding between Iran and the United States has now expired. What does that mean? What is going on? And how is it continuously affecting the stock market? So let's move to our first topic, U.S. Treasury bond yields and interest rates moving higher. And we've noticed, we can actually pull up our first chart of the 30-year Treasury yield. Look at that movement to the upside. Not something we see quite often. And in fact, the last time we saw such large moves was actually 10, 20 years ago. We haven't seen the 30-year move this quick, this fast, in quite some time. And if we go to our next chart, which is the 10-year Treasury bond yield, there it is, a little bit more gradual, but still moving significantly to the upside. And many people are nervous that we could see the 10-year go through the 5% mark and the 30-year get closer to 6%. Very, very difficult for stocks, for even bond holders. As we know, when yields or the rates go up, bond prices come down. Those are their owning bonds. They're seeing their bond pricing come down. Not a good thing. Let's look at the 2-year Treasury. And it's an interesting thing because you're going to notice it's kind of flat. It doesn't tend to move an awful lot, or hasn't moved an awful lot, because the 2-year is what is more controlled by the Federal Reserve. 2-year Treasury. What does that mean? Well, that is telling me that the bond market actually does not believe that the Federal Reserve is going to increase interest rates. We know that the chances of raising rates in September now is below 50%. At one point, it was above 50%. But the 2-year tends to move a lot more with what the Fed is saying, or is going to do, at least what the market believes the Fed is going to do. And the longer term rates are more moving with, yes, they move with the Fed, but they move with other factors. And these are the factors I want to talk about. But before we do that, let's look at global 30-year government bond yields. And there you have them. So it's not just the US, although the US has been probably the steepest move higher. Looking at places like France, Japan, Germany, all these bond yields, these 30-year long-term bond yields, are moving at a rate that, frankly, we have not seen in quite some time, and some would say maybe even ever. So why are these longer-term rates moving higher? Well, there are 3 reasons that people have come up with. First and foremost, which seems to make a lot of sense to me, is that when you issue bonds, you issue them in an auction style, right? Countries come out, United States, Canada, Japan, Germany, whoever, they'll come out and say, hey, we need to raise some money for our country to pay our debt obligations and to do other things. So we're going to issue a 30-year bond. And then other countries will come in, perhaps hedge funds, perhaps big sovereign wealth funds, all the big players, pension, mutual funds, they'll come in and they'll buy government debt. However, what we've seen recently is that there is a lot of competition for this debt. Let's go to our next chart, and this is going to clearly show what I mean. Companies like we call the hyperscalers, Google, Amazon, Microsoft, many others, Meta, they're issuing bonds themselves, long-term bonds. We just had an announcement of Google issuing debt in Australian dollars. And these, competition between these big corporations, who are many of them AA or AAA rated, they're issuing debt because they need to raise money for their AI ambitions, to continue to develop AI and chips and data centers, etc. And they're in direct competition with what countries want to do, what the United States wants to do in raising capital or in a bond auction. So supply and demand. If there's a lot of supply for debt, which is seemingly what's going on right now, then the demand just isn't there for all this debt. And what we're seeing is, in many cases, that a lot of the government debt is not being purchased as quick, not as much of it. And to entice investors to buy this debt, government are going to have to raise the interest rates, which is what they're doing. Just like these corporations have had to raise the rates on their debt to entice people to buy their bonds. So supply demand, one reason why we're starting to see bond yields, especially longer term bond yields, start to rise. Our next chart shows the debt levels, for example, in the United States. Look at that, close to $40 trillion. Unbelievable. Again, this affects the longer term debt that a country will, like the United States in this case, will offer. Are people as willing to buy debt from a country that already has outstanding $40 trillion worth. Imagine the interest expense on that debt, well over $1 trillion itself on a regular basis. So high debt levels, people are starting to focus on, countries starting to focus on these high debt levels, these other companies issuing debt to compete with federal government debt, and two big reasons why we're starting to see yields rise. The third reason, which we've kind of touched on, our next chart, CPI. We obviously are seeing CPI rise, although it's come down the last few months in the United States, still well above 2% target. The core rate, 2.5%, still above 2% target. And the headline number, 3.5%, 3.4%. Obviously, that is affected by oil. And the bond market says, hey, oil prices are not coming down. The issue in the Middle East, the war in the Middle East or conflict in the Middle East is not going away. The longer oil prices remain elevated, the more we could see inflation elevated. And so that too is having an effect on long-term debt. So all the reasons why, or at least three reasons why, people have been talking about why yields are rising. And when yields rise, individual investors start to say, hey, why would I buy a stock that's maybe paying me a 4% dividend when I could go, sitting in the United States, I could go out and buy a bond that's going to pay me 5% interest from the government or from a AAA rated or a AA rated corporation, safer, whereas the dividend can be changed. The company's stock could fall depending on the market. So what happens is when yields rise, it pulls money out of the stock market and more money moves into the fixed income market. And that's one of the things that we've been seeing. And so when yields rise, stock market tends to pull back, especially technology. And that is what we've been seeing. So higher yields, not a good thing for the stock market, for mortgages, for the real estate market. We want to see interest rates come down, not move higher. So definitely something to consider before you make your investment decisions. Our next topic that I wanted to discuss are the upcoming quarterly earnings from NVIDIA and earnings from our major banks. NVIDIA will report earnings next Wednesday, 1 week from today, and our banks will kick off their earnings next Tuesday with BMO and Scotia, and then on Thursday you'll have the rest, RBC, TD, and CIBC. Let's pull up a chart of NVIDIA, our first chart for this segment. There you have it. And, talking to individual investors as I have recently, talking about NVIDIA, you could clearly see the stock really didn't go anywhere from last September to this April, shot up a little bit on some positive headlines, good earnings. And really since, let's call it May, it's been up, it's been down. Lately, it's been back up in the month of August. So individual investors that have owned this stock, they've been rewarded at certain times, but then they've definitely had a very bumpy ride. The next chart that we have shows why NVIDIA is so important. Not only is it the largest company in the world today, largest tech company, but you can see there, I know it might be tough because the writing's a little bit small, but NVIDIA is in the middle of this diagram. What is this diagram of? NVIDIA is at the center of circular AI deals, all the AI deals. They call them circular because AI is helping to fund some of the deals with these companies. So they give money to companies, and in turn, these companies buy NVIDIA chips and NVIDIA products. So a lot of people think that this can't last. Eventually, something is going to go wrong, and this circular pattern will be the demise, perhaps, of some of these AI names. You can also notice here, OpenAI, ChatGPT parent. They're a big player here as well. A lot of arrows coming in and out of OpenAI, but make no mistake, NVIDIA, $5 trillion company, sits at the heart of everything. SpaceX, Intel, AMD is a bit of a competitor to NVIDIA, so that sits around the outside, but you can see all the arrows coming out to and from NVIDIA. It is very, very important and definitely will be market moving. We will get a very good picture of how AI data center is doing when NVIDIA reports next Wednesday. Turning now to our Canadian bank stocks. This is a very interesting sector right now. Canadian bank stocks, as many of you will notice who own Canadian banks, which are probably many of you watching, they've just been on a tear whether it's CIBC or Royal or TD, it doesn't matter. They've all been moving higher. Let's pull up our first chart. It's a bank ETF, and we've seen this chart many times. Look at that chart from last September to present. It's just been a beautiful line from the bottom left to the top right. And if we look at individual banks, they all look the same. Let's look up Scotiabank, our next chart. Chart will look almost identical. You could probably put one on top of the other, and there wouldn't be much difference between Scotia. Let's look at TD. If you were to put that one up, there it is. Same thing. And then last but not least for us, CIBC. Look at that chart. Again, all look the same, and they all look the same as the actual index itself that we showed, the Hamilton ETF. So what is my fear heading into bank earnings next week? Well, I've said this on previous shows. I believe these banks are priced to perfection. We continue to see them move higher. We've had announcements by government saying that these banks don't have to keep aside as much money as they normally had to for bad debts and for difficult times. Governing bodies in Canada have said that Canadian banks could keep as much as 5% less on reserve so that they could spend this money in growing their business and doing whatever they need to do to be successful, acquisitions, etc. So that helped the banks most recently and took them to the next level. However, coming into earnings season, let's take a look at Canadian bank PE ratios. Our next chart. There it is. National Bank, 19. Royal Bank, 19. TD, Bank of Montreal. All of these banks well above their averages. I remember when CIBC PE was 9-10 times forward earnings. I remember when TD was 12 times forward earnings. Royal Bank, 12 times forward earnings. Now we're looking at 19 times earnings. So what do I say? Well, if you take a look at where the banks are all trading now, and I'll give you some of the prices in a moment, and you look at their average PEs over the historical numbers, if you were to take their historical PEs and put them on where, what the banks are doing today. So what would be the price of their stocks today if they traded at historical PEs? That is our next chart, and I believe one of the most powerful charts of our show today. Those current prices are a little bit old. I can tell you Royal Bank now is at 288, TD's at 164, Scotia is still at 122, BMO is up to 244, and CIBC is around 164. Now, their current PEs, you have it there in the next column, very, very high. 10-year average PEs, look at those averages. I think Royal Bank is probably 10 to 12. Definitely TD is probably also about 11-ish, so a little bit higher than that. BMO is probably right on. Scotia has had some difficulties, so their PE multiples are low, and CIBC was really low for a long time. If you were to take their average PEs and use that instead of what their PEs are today, which are much higher, look at how much or how low the prices would be. You're looking at a difference of possibly $100 in Royal Bank, TD much less as well. In some cases, you're looking at stocks prices being almost half of their values, and you can see the downside, 40%, 46%, 55%. So what does this tell me? Well, these are all approximations, of course, but that tells me that the bank stocks are, in my opinion, at best fairly valued, and in many cases stretched or overvalued at these levels. And as we get their earnings next week, starting on Tuesday, if these earnings are not blowout or above expectations by enough, we could see these stocks perhaps pull back a little bit. Could that be a buying opportunity at that time? Maybe. But for now, I'm a little hesitant looking at bank stocks. So earnings from NVIDIA and banks, very important to watch over the next week or so. Our third topic that we tend to talk about quite often is obviously the conflict in the Middle East, and definitely something that individual investors need to be focusing on, the price of oil. Every now and again, we hear that a tanker has been attacked and a projectile being thrown at some kind of tanker from some country, injuring people, perhaps even killing people, and damaging these ships, deterring tankers from traveling through the Strait of Hormuz. Let's look at our first chart, ship traffic through the Strait of Hormuz. you can clearly see right in the middle there of the chart, June 17th, or U.S. and Iran reach peace deal. And you saw the number of tankers traveling through the Strait of Hormuz well above 50. And look what's happened since then. Memorandum of Understanding has now gone away, and that we know of. Again, keep in mind, a lot of these tankers turn off their transponders so they can't be detected. They're traveling in the middle of the night. So according to the United States, the Strait of Hormuz is open for business, but we're just not getting the same kind of data flow that perhaps the U.S. is. U.S. is saying a lot of tankers are going through, and we're seeing very few, or at least we're getting the data that very few tankers are going through today versus at the top you see pre-war average 130 ships per day were going through the Strait of Hormuz. The next illustration that we have shows the pathways, or I guess the traffic that goes through the different routes. Iran wants the route to go near to them. The pre-war route was kind of in the middle, and Oman, which has been in talking to Iran, and the two of them are trying to do things such as putting tolls on tankers, etc. The United States wasn't happy recently, and they actually threatened to bomb Oman or to get really angry with them if they continue to cooperate with Iran. So just wanted to show some of the routes that these tankers are taking, have taken, and what Iran would like to see. The next chart that I wanted to show is very important, and this is the stockpile, the reserve that we're seeing in the United States. At the peak, you can see here near 727 million barrels of oil that the U.S. had in reserve, now going below 300 million barrels. And that starts to get a little bit nerve-wracking as countries around the world continue to dip into their reserves, as much of the oil, 20% of the world's oil that flows through the Strait of Hormuz, is still blocked, partially blocked, somewhat blocked. We're just not sure what to believe at this point in time. But we know that oil is definitely not coming out of that region as it used to be. Next chart shows oil prices, right? We're seeing oil prices today, WTI in the mid-80s, and Brent crude above 90. Brent crude, again, is the oil price for Europe. Our last chart of this segment is actually one, again, I say a fantastic chart. And when everybody talks about oil and inflation, I wanted to show everybody how, I guess, how these two things are so intertwined, how much they are related. There you have it. Let's take a look at that greenish or turquoise green headline or line, U.S. headline CPI. Look at that flow and look at the change in crude oil. The black line, look how closely it follows it. You see the oil or crude oil spike. Recently, you saw a headline CPI spike. CPI is coming down a little bit. Hopefully, crude oil comes down as well. And this I have to draw, or I have to talk about with respect to the Federal Reserve. And I've said many times on TV, on our shows here, that I don't believe the Fed, I don't believe the Bank of Canada should raise rates to combat inflation, because this clearly shows that inflation is moving with the price of oil. You want to bring down inflation? Bring down the price of oil. However you have to do it. Get more oil produced, figure out how to get those tankers through the Strait of Hormuz, do what you need to do to bring down the price of oil, and U.S. inflation and Canadian inflation and global inflation will follow. Raising interest rates, in my opinion, just doesn't work. It will not help bring down, raising interest rates will not help bring down inflation. So let's keep an eye on what's going on in the Middle East. We always have to keep an eye on that. Let's take a look at what the bank earnings are going to tell us next week, along with NVIDIA. And U.S. Treasury yields, will they continue to rise? We saw the Treasury in the United States today talk about buying back more of the bonds that have been issued. That helped bring down those long-term rates, at least for today. But will that be temporary, or will we see yields start to move higher once again? Those three things, in my opinion, should be on the minds of individual investors before you make your next investment decisions. So we we've seen S&P targets actually rise recently from a number of individual institutions in the United States, whether it's a Goldman Sachs, or others. We've seen at one point in time, many of them had a 7,500 point target on the S&P. Well, that doesn't really work at this point unless you believe the S&P is going to pull back an awful lot, because we've hit as high as 7,800 on the S&P 500. Many firms such as Yardeni Research, Ed Yardeni, who is very popular, has been on shows on the TV, CNBC. I think they've even been on BNN. He's been on BNN talking about how he increases his target for year-end S&P 500 to 8,400. Tom Lee, a very well followed analyst as well, and a student of the market, also has higher targets for the S&P 500. So our first chart that we have clearly shows what the targets have been and what they're up to now. You can see Goldman Sachs coming in at 7,600. There it is. But you look at JP Morgan, 8,000 point target, more and more targets, Deutsche Bank, and you're looking at Citigroup, and you're looking at Oppenheimer, Wells Fargo just under 8,000, and Societe Generale 8,000. A lot more of these 8,000 point targets, 8,100 point targets. I think you're going to start to see all those 7,500 point targets, HSBC, Jefferies, UBS, start to move significantly higher. So do these targets really mean an awful lot? In my opinion, I would say no. These targets are only as good as the market, really. And what tends to happen is, if you follow these targets, you end up, in my opinion, getting the short end of the stick, because these individuals are always taking up or pulling back their targets. They are just an approximation and a best guess. But even though these targets are moving higher, individual investors, if you talk to them, and as you know, I talk to people all the time, investors all the time, they're actually talking to me about how they're seeing a lot of market swings, and significant ones. And it's made them a little nervous recently, especially coming out of the month of July, where we saw a lot of market swings. So these targets are moving higher, even in the midst of seemingly bigger swings in the market, day-to-day, week-to-week swings in the market. Let's take a look at some of these swings. S&P 500, our next chart. This is a 3-month chart of the S&P 500. Look at that. Really not going anywhere until August, but you're seeing these swings. And one of the things I want to point out to investors is, yes, we are experiencing these ups and downs, but net, you really didn't go anywhere from June and saw a bit of a downturn in July. Now we're seeing an upswing in August. Net, how far have we gotten? Probably not a lot. So yes, the days may show, and the weeks may show some swings, especially in July. Technology had a very difficult time, but August, technology, at least in the first couple of weeks, has done extremely well. Speaking of technology, let's show Investor QQQ, which gives us an indication of tech. There it is. Look at those swings. Look at that big dip. What is that? I would say 4th week of July. Unbelievable. Started in the 3rd week to the 4th week. We saw a big downturn. And so, yes, even though targets are being taken up for the S&P 500, for the stock market in general, it doesn't mean that you're not going to experience these big swings. I would say these big swings, unfortunately, are here to stay for now. Always remember, right? A lot of individual investors have experienced tremendous upside this year, and there's always going to be some downside. We'll always give back some of the gains, unfortunately, only to see the market move higher once again. So the big ups and downs are just a product of the way the market is functioning right now. And yeah, unfortunately, we're all going to have to get used to it going forward. Buying opportunities, as I said off the top of the show, they're always there. I get a lot of individual investors calling me up and say, Allan, I have some money that I just came into. Is it a good buying opportunity now? Is it a good time to buy? And my answer is always the same. There's always a good buying opportunity out there. And it's the job of the investment advisor like myself to find those opportunities for you. And sometimes, yes, it's more difficult than others. And sometimes it's a little bit easier. And yes, it's easier after a bit of a sell-off. That's why you get that term, or investors like the term, buy the dips. When the market dips, you like to buy. When the market goes up, it's a little bit more difficult to make those buys on some of the best good quality names on the stock market today. So let's look at our first chart, which is the stock exchange forward PE ratios. You're looking at the S&P 500. We can pull that up. We actually have the forward PE ratios. There they are. S&P 500, 20 times forward. NASDAQ, 27 times. I've seen the S&P 500 up to maybe in around 22 times. NASDAQ closer to 30. So they are down a little bit from their previous highs, but still, not that cheap. We like to see the S&P if it gets in at around 17, 18 times. That, to me and to many investors, would be a signal that there are bargains out there. Let's look at some of the individual sectors to show you what we're dealing with right now, how much these sectors, how widespread the recent market upswing has been. Let's take a look at our first chart here on U.S. pharmaceuticals. Once upon a time, a sector of the market that individual investors didn't even look at. A lot of these pharma companies were left just sitting there, in fact, falling. And now look at the run these pharma companies have had. Next chart, U.S. financials. We've talked about it many times. One of the benefactors, or one of the sectors that has benefited most from the AI surge. AI profitability, efficiency has spilled over to U.S. financials. Look at that chart. Next chart that we have, I put in here is the gold chart. Now you're going to see gold moving to the downside a little bit, but a recent upswing because it was thought that the Fed does not have to raise rates. The US dollar had a bit of softness recently, and that is good for gold. But gold has had a huge swing over the last few years, going all the way to 5,500 an ounce and coming back down to below 4,000 and now back well above 4,000 again. Let's take a look at the Invesco Aerospace and Defense ETF, showing us defense stocks a long time again that they didn't really move for a while. They were choppy at best. Look at the defense stocks. Some of it have come down recently, but I can tell you in the last few days, defense stocks have done really well. Lockheed Martin, Boeing, you look at Northrop Grumman, General Dynamics, a lot of these companies just doing fantastic right now. As you can imagine, right? Whenever there's a war, a lot of things have to be made. Missiles, different weaponry, planes, you name it. These defense companies produce it. Last but not least, semiconductors, right? We look at the semiconductors and we look at this chart. There it is, gone up for quite some time, but has recently pulled back, leveled off a bit. And I think, yes, what does that mean for being able to buy some of these chip makers? I think some of these chip makers are now a little bit cheap. I shouldn't say very cheap, but they're definitely at least cheaper than where they used to trade. We saw names like Micron sell off quite a bit. AMD recently has sold off quite a bit. NVIDIA, as we showed earlier, has spiked higher, but recently came down a little bit. A lot of these semiconductors now, maybe you take a look at once again, but make no mistake about it. It's become a little bit more difficult to find those big winners, those diamonds in the rough for individual investors. I think if you're someone looking for some good ideas, you have to do your homework now, probably more so than you had to maybe about 6 months ago. The markets have definitely moved significantly higher. We're all seeing it in what are the month-end statements that we get on our portfolios have moved significantly higher for many of us, and that's a great thing. And it just makes the job, my job or investment advisor's job, a little bit more difficult. But as I said, there's always a good opportunity out there. We just have to go out and find it. Wanted to talk just briefly about Jackson Hole. Jackson Hole is going to be coming up next week. And what is Jackson Hole? Well, Jackson Hole is a place in Wyoming that the Federal Reserve goes to every year. There's a symposium where the head of the Fed, for the longest time, Jerome Powell and many others before him, now it's Kevin Warsh, will give a speech the end of next week. And he's going to talk to us about what he sees out there. And this is, I think, a very important speech, definitely market moving, because Kevin Warsh basically has told us that he's not going to talk to us a lot about the markets or where interest rates should be or where they're going on a regular basis. He's going to be more opaque than Jerome Powell was before him, and he's not going to give us any indication. So whenever he does speak, it definitely will carry a lot of weight. Funny that we have a good illustration showing the tightrope that Kevin Warsh is going to be walking between raising interest rates or lowering interest rates. I don't think they're going to be lowering them, but perhaps raising them, and the higher inflation, which may cause him to raise interest rates. Obviously, we don't want him to raise interest rates in the US. That'll affect us here in Canada. It'll affect the stock markets all over the world if the US starts to raise rates. So there's that tightrope that he is walking. I thought that was a fantastic illustration there. Next, we have a quote actually from Bank of America's August Global Fund Manager survey, and it reveals that investor sentiment has reached the third most bullish level since 2022, with a record consensus conviction around a no landing economic scenario. No landing just means that we'll see continued growth even with higher or elevated interest rates. So we're coming into Jackson Hole. We want him to say something positive, obviously, for the markets, for the bond market. And as the survey says, the third most bullish level since 2022. What if Kevin Warsh is not bullish? What if he talks about raising rates? What if he says something negative, or at least something that the market deems as negative? What will happen? Well, we could see a bit of a sell-off in the market. We could see the markets, having a bit of a temper tantrum because they want to see something good. And the quote goes on to say that his opaque communication style has created a considerable uncertainty, making Jackson Hole unusually high stakes event for market participants seeking clarity on policy outlook. So there you have it again. That's the second paragraph there. So because of Kevin Warsh and the Fed's opaqueness, not talking to us often, these moments like Jackson Hole's speech will be crucial for the market to get a glimpse as to what the Fed thinks they will be doing going forward, raising interest rates, not raising rates, maybe even cutting rates by early next year or at the end of this year if we can see inflation down. What will Mr. Warsh say? Jackson Hole definitely is something to discuss. And when it happens, we will all be waiting to see, I guess, on pins and needles, what will the Fed say? What would Kevin Warsh say at his speech at Jackson Hole? And like every speech by the Fed, we will parse through every word that comes out of his mouth during his speech. Quick hits, 3 things that I've seen in the news over the last couple of weeks that I thought were interesting, that caught my eye. Here you have them. As always, we have 3. Ontario unveils new data center framework amid calls for moratoriums. And I know Premier Ford is big on data center. We're going to read a quote from him shortly that he wants to move forward and create the jobs of the future, which definitely involve data center. AI optimism fades among young adults. A lot of younger adults think that AI is coming for their jobs. And more young adults believe this will be the case. Canada Pipeline plans hinge on uncertain output. And that's a Reuters analysis. If they're going to build these pipelines, Canada needs to increase output. Can we increase capacity enough to make these new pipelines worthwhile? So let's move to our first quick hit. Ontario unveils new data center framework amid calls for moratoriums. And let's move to the quote by Ontario Premier Ford. He announces data center framework, and here's the quote. Ottawa has a choice. We can build the economy of the future and ensure Canadians' data remains in Canada, or we can get left behind and risk Canadians' data being sent to the US and elsewhere. Through our new data center playbook, our government is choosing to build the economy of the future to generate billions in economic growth and create thousands of new jobs while ensuring new data centers play by the right rules and pay the full cost of electricity. So he's basically saying if we can control the costs, there is no reason why these data centers cannot be built in Ontario and, for that matter, all over Canada, because this is the future. We see how many data centers are being built in the United States and many other countries around the world. We need to compete, and if we can compete with these countries, this is what we need to do. So I agree with Premier Doug Ford. Our next quick hit, AI optimism. Our one chart for this one clearly shows that with young adults, 55% are more concerned than excited. I think that has definitely switched. More excited than concerned, down to 11%. And I think this has to do fully with this idea that AI is coming for our jobs, especially the younger generation, those that are entering the workforce. A lot of the lower level jobs, entry level jobs are now possibly being replaced by AI. I guess the counter argument to that are newer jobs, higher paying jobs will be produced by AI to offset the jobs that are being lost. But definitely, younger generation not happy, or not definitely not as happy as they used to be with artificial intelligence. And last but not least, our third quick hit: Canada pipeline plans hinge on uncertain output. How much output can our country produce to warrant all these new, and let's pull up our chart for this segment, the new pipelines. There you have it. The Enbridge Mainline Phase 1 optimizations approved. Trans Mountain approved. Enbridge Mainline Optimization Phase 2, it's proposed but not approved. And you have other pipelines there as well. If all this can get approved, can get done in the coming years, think about how much of a powerhouse our country can be, will be, if we can get our oil to port, if we can send it around the world. And as we know, especially what's happening in the Middle East, other countries need our energy production. They need our natural gas. They need our oil. And in my opinion, if we can increase production and get these pipelines up, that's a win-win for our country. What's my take? This is a part of the show where I take one question from our audience. And this question actually came in during the last week, I believe. And it reads like this: the Bank of Canada has held its 2.25% interest rate for 6 straight meetings. Do you think the next move is a cut, a hold, or a hike? Well, that's an easy one. I would say the next move is going to be a hold. And we're going to continue to see the Bank of Canada hold, because I don't believe it is in the country's best interest to raise rates. As I said earlier, that's not going to prevent oil prices from rising, which is causing inflation to rise. So by raising interest rates, all you're doing is making it more difficult for other sectors of our economy, such as real estate, to do well, to flourish. And we know that real estate is having a difficult time here in our country. Raising rates raises interest rates on things such as mortgages, lines of credit, things like that. And that is never good for our economy, which is only just barely getting out of a technical recession. Perhaps we're growing 1-2%, nothing great at this time. So I believe the Bank of Canada is on hold. I am hopeful that the next move maybe could be down. I don't want to see rates rise. It'd be nice to see a rate cut by the Bank of Canada at some point, maybe early next year. We'll have to see a lot of things happen between now and then for that to happen. So with that, I want to say thank you to everybody who tuned into our show this afternoon. Hopefully we're able to give you some targets for the future, some look ahead to some really big earnings next week. NVIDIA, big banks. I know that is at the top of everybody's list living here in Canada. Hopefully there will be some takeaways for everybody from our show. It was, as I always say, information packed. We will be back on air 2 weeks from today, as always, at 12 noon across all social media platforms. That is Wednesday, September the 2nd at 12 noon, of course. And we look forward to seeing all of you again. And until then, happy investing.